Awesome. Thank you, sir. And welcome, everybody. Very thrilled to have you here with us. And as always, just honored that you'd invest a little bit of time out of your busy day to be with us and learn a few things. So shout out to all of you for joining us today. Thank you. Thank you. Some of you have noticed some changes in the marketplace, there have been some changes to the marketplace. So we're going to talk about that for most of today. We're going to go over all of our kind of usual major metrics, major indicators, and then we're going to do actually some other kind of interesting ones that we don't usually do. So I think you guys will get a kick out of that. And let me see here. All right, I got my share going. Things are looking good. Okay. The year is 1937. April 25th, 1937. From the newspaper in 1937. A couple interesting listings here. I'll just call one out. 3809 Longfellow South. $3,450. About 350 bucks down. 30 bucks a month. And get this, you pay it like rent, right? It includes interest and principal. 1937, it was a different world back then. Can you even imagine 350 bucks down and 3,500 cash to buy a nice Longfellow home? All right, anyway, it's fun to reminisce about the old times. I think you guys might have seen this one before. I want to acknowledge that in these times of change, while we cannot control the wind, we cannot control the changing winds, what we can do is adjust our sails. And that's something that I think we all ought to be thinking about, and we'll touch on it a couple more times. And this has been attributed to a couple different people, so I just wasn't sure who to attribute it to. But I think it's important. All right, a little bit of a lighter note. They say economists have predicted 17 of the last 3 recessions. You heard that right, read that right. 17 of the last 3 recessions, but this time they're probably right. I don't know if we're in one or will be in one, or if it'll take some time to get in one. That all remains to be seen, but I got a kick out of that nonetheless. You guys know, if any of you have pets, the little dog collar, if there was a procedure or stitches or something, some of us might need those to keep us from looking at our phones every 2 seconds. So feel free to employ whatever tactics you deem necessary to absorb this information. We've talked about this before. Without data, you're just another person with an opinion. And I think your clients know that. I really do. All right, this one's from Jackson. Just before we get going, I think, Jackson, you're the one that sent this, right? I think you are. So Jackson shared this, and I really kind of got a kick out of it, and I wanted to share it with you all. So here's a pile of data, right? Just a pile of Legos. And then we can sort the data kind of by group or by color, and then we can kind of arrange the data or Legos sort of by type. We can present the Legos or the data visually, but then we can talk about the data using a story and telling a story of the market and of what's happening with buyers and sellers and prices and market times and inventory. And this, I got a kick out of this, so I wanted to share it with you guys. All right, enough with all the introductions. Let's get into some showings data. So hopefully some of our regulars today will recognize this one. We've got 2019, 2021, and 22. Darker the color, the more recent the year. And we can see the 2020 pullback in COVID, when COVID kind of arrived on our shores here early March, well, mid-March. And then the second half of the year of 2020 really made up for those losses. And then look at the first half of 2021 as well, really just soaring sky high. So it was really the second half of 2020, first half of 21 that were really kind of the frenzy years, or frenzy period, I should say. And now we're paying a little bit of that back. We've got a little bit of a tab to pay back on that. So here we are, 2022. You guys can see, what is this? Memorial Day, 4th of July, just got through Labor Day. So you can kind of see the dips, regular kind of holiday dips. But you'll also notice that we are definitely trending below the prior few years. And you can kind of see when that started happening, right? As rates really started to crank up, when we started seeing those high inflation readings on the CPI, March, April, we really started to see that divergence. Showing activity by price range, because the market is not monolithic, right? We have to break things down into buckets: property type, price point, construction, that kind of thing. I never loved the one that just shows the raw numbers, but let's just pause on it for a second. Showing activity down in every single segment, with the exception of 800K to $1 million and $1 million plus, where we saw modest gains in $1 million plus, but fairly substantial gains in 800K up to $1 million. I like the percentage. I always like to look at the share versus the number. So guys, even though all segments but these two were down, some actually rose in terms of market share. Why? Even though they were down less than other segments. And so that is a thing that can happen. And I know sometimes that's a little wonky or a little confusing for folks. But here you have it, 800K to $1 million, nice bump there in the share, also $1 million plus. And even as we see 250 to 300 going down, looks like 300 to 400K pretty flat. But then we do start to see increases in the share between 400 and 500,000. No surprise there. What's 425 today was probably 375 a couple years ago. So it probably would have fallen into this bracket. Instead, it's sort of aged up into that next price cohort, if you will. Looking at that on a percentage change basis. So MLS wide for that week ended, most recent week this year versus the same week last year. Here you have it, you guys. Our only two gainers, luxury, sort of true luxury over $1 million, and maybe, I don't know why we always goof around with these words, bronze or gold versus silver luxury versus gold and platinum. I don't know. Anyway, a pretty big gain in that 800K to $1 million range. Okay, this is a new one, guys. Change in showings year over year. So let's actually try to measure the change. By price point, we just did, but let's just look at overall. So this is a rolling weekly average. You guys can see, you can see the trend line here, hovering kind of on either side of 20%. Looks like we had a little bit of a change as we got back to kind of break even for showings. That's encouraging. So that's a rolling weekly average. And look at this, you guys. Notice in early April, look at this trend line. This trend line kind of got to 20%. So the trend line hit about 20% in April. And now let's look at pending sales. June and July, down just about on either side of 20%. It's almost like the showings data was a leading indicator of this. By the way, the showings data is really a good leading indicator for demand, as we saw. So signed contracts down about 20%. And that happened only about 2 to 3 months after showings displayed a similar decline. So you want to look at what's happening with closings tomorrow, look at pendings today, and look at showings yesterday. All right, so here I'm using a rolling 2-week average, and you guys can kind of see, if we squint and turn our head to the side a little bit, we can kind of see a little bit of a curling up. I'm not saying this is conclusive. I'm not saying that, the worst is behind us, but I am saying that it looks like, based on this trend line, that we could be turning a corner in terms of the showings declines. Now, it's possible we level out at minus 15% and kind of level out, but at least it looks like things aren't worsening, and it looks like we're not staying at down 30%, right? So we'll keep tracking that, but I thought it was an interesting observation, as I do all of these charts. Big shocker there. All right, new listings, guys. Let me pop open chat and just make sure. What do we have? Slepsky, what are you saying here? Sales tax on my recent car was more. I just read the average, I don't know if it was average or median, but the typical new car price is $46,000 and change. Holy cow. What a number. Everyone's going to be buying 1995 Honda Civics and Toyota Corollas, huh? All right, so new listings, you guys. Similar story with showings. We've got the prior 4 years. So this is seller activity, not buyer activity, seller activity here. And you can see we were, sellers were more or less on track, pretty close to prior year levels until what? End of July. about mid-July. But buyer activity started to fall earlier, right? More like May, early June. Buyers are always going to be more nimble than sellers, right? They can just say, I'm going to pause my search. But sellers, I mean, they got listing agreements. They maybe are already looking at their next home. They've put stuff in storage. They've staged. They're committed to selling and moving, or they got the third kid on the way and they really need more space, what have you. Sellers are always slower to change their game, and buyers are just much more agile in that way. I know you guys understand that better than most people. So here we are, guys. Market is rebalancing and normalizing. We're still coming down from these pandemic historic highs. Until a few months ago, the market was driven by historically strong demand and low supply. And then on the finance side, of course, that was delivered through cheap money, but not easy money. And that's a huge difference. Really important to make that distinction. We're still below our long-term price trend. Rates have been changing, especially this week, given we had some slightly hotter than expected inflation data on the CPI, Consumer Price Index. I think it came in at 8.3%, and Wall Street was expecting 8.1%. However, it was down from the previous month, and it was down from the high, which I think was 9.1, but not enough to satisfy Wall Street. I think that's why some now call it the Dow Jones, not the Dow, but the Dow Jones lost, what, 3% the other day. No big deal. Sure, it'll come back. Some of you should watch Warren Buffett and Charlie Munger. These guys, some of the most successful investors, they say, there are people who obsess themselves over the stock prices and ETF prices as they bob up and down every day, every hour. He's like, you make an investment, you sit on it for 20 years and you'll get rich. He's like, pay no attention to these equity prices bobbing up and down, which is funny because I've been trading a little bit more. Anyway, affordability has been deteriorating. We still have tight inventory, guys. We still have about 1.8, not even 2 months of supply. So, I think some of this is, it's important to name things, but it's also important to say we're comparing against a really high level and we're kind of coming back into what might be, more historically average. It looks like a big change, but I think we're actually only down about 7% compared to 2019. So from pre-COVID levels, although it looks like we're down 20 or more percent compared to COVID levels. So baselines matter, you guys. Baseline periods matter. And then this will come up a little bit too. Some demand that would have taken place, so sales that would have occurred during 2022 or 23, some of those were displaced or pulled forward into 2020, 21 because of interest rates, because of the rush on housing, because people all wanted single family, because people wanted out of some shared living type situations because of health concerns, so on and so forth. All right, price appreciation. USA versus Minneapolis. You guys will notice we are well below the nation as a whole in terms of price appreciation. That's a good thing because the higher you climb, the harder you fall. Speaking of falling hard, how are our friends in Phoenix doing? I bet you guys have been reading about Phoenix. Technically, they didn't hit the same appreciation level as Tampa, but they've really started curling down hard, right? Where price growth, once what, 33%, it was now more like 25%. Hard to call 25% price growth a slowdown, but relative to 33 or 35, it is. And notice, the trend just really coming down. Here we are, Minneapolis, a little bit below Boston, below the nation as a whole, and below, Charlotte, Atlanta, and what I might call some of our sister cities or our peer cities. All right, great mean reversion. 1960, you guys, we're looking at data from 1960. All right, housing bubble, housing hangover. Enough said. So this is the channel, you guys. This is our long-term channel. If prices rose as they have over the last 60 years, 60 plus years, if they rose at about 5.5%, we'd be dead in the middle of this channel, right? Smack dab in the center of this channel. But we know that markets don't move like that, right? Stock markets don't move like that. Housing markets don't move like that. It's just not the way markets move. So sometimes we're above and then we're kind of back on trend. Sometimes we're way above trend and then well below trend. And what I notice now, I don't know about you guys, but what I notice now is we're just kissing the bottom, the lower bound of that channel. So, this should have screamed out to us, we're in a bubble. We're way ahead of our skis, right? We're way overstretched. But now, we're kind of getting back into that channel. And I think it's pretty clear that we will not be increasing at that kind of rate, and that we'll probably be increasing at a flatter rate. So, all things to think about here is we're just kind of on the bottom end of that channel. I'm amazed. Some people really believe that we're here. Some people really are so convinced that we're here. And the data just confirms that we're simply not. We're simply not there. All right, August new listings by price range. Here's 300K and under. And I know that's a little bit small, you guys. 300K and under in blue, 300 up to 600 in red. I know that's a big range with a lot of different product type. And then 600K plus in green. What do you notice about seller activity? There's only one segment where we're seeing these declines, but it represents the bulk of the market. It's sub 300K, where seller activity was down 28%. Listings between 300 and 600 were up 2%, so that's pretty flat, right? About 700, 650 more or whatever. And then 600K, we still saw a 25% increase in incoming supply, in new listings, seller activity. Guys, if these folks are gonna, if most of these folks have to be buyers, these are the price sensitive folks, and now they're rate sensitive folks, right? These folks just aren't as rate sensitive, just better capitalized buyers typically, higher net worth individuals typically, higher likelihood of being cash buyers typically, and that sort of thing. Your truly rate and payment sensitive buyers are going to be in the more affordable brackets. So of course, when we shift to the demand side, to the pending sales side, signed contracts, accepted offers, signed purchase agreements, all the same thing, we see a little bit of a similar story. So here we have this 28% pullback for listings under 300K. We saw 28% fewer signed contracts this August than last. For the 12 months ending this August than last, I should say. And so, yeah, so a little bit of a decline in this next range, and then actually still see increases in demand as you get over 600K. Maybe some of you are going to be surprised by that, but that is what we see from the North Star data. All right, don't be mean, be above average. Statistics everywhere. Everywhere I look, I see numbers. All right. August new listings, everybody. August alone, we had several months back in the good old days of 04 to 06 at 10,000 incoming units just in a month. We've kind of been floating between 7,000 and 8,000 for years, right? For years and years. So sort of heading into the Great Recession and the mortgage and foreclosure crisis, and then clawing our way out of it. But you guys will notice supply levels really never got back to where they were. In fact, supply levels have been flat for a long time, even as demand has gotten back to all-time record highs. So that's really a big factor that's been driving this market up until the last few months, where things have really changed. So here we see seller activity really falling off almost 20%, and its lowest level since 2012. So it's just about a 10-year low, you guys, just about a 10-year low. Pendings showing down 23%. But again, this is what I was talking about, everybody. We're comparing against this heightened baseline period, and I'm not sure that's the best way to set up our analysis, although the fact of the matter is sales were down 23.5% compared to last August. That's the fact. So let's name that. However, however, let's also name the fact that, we're only down what, 8% or something, or let's see, 10%, no, 12% from 2019, something like that. So, I think sometimes that's a little bit of a better comparison. Is that 15%? Should be able to do that math faster. My brain's scrambled. Having twins who don't sleep all that well will do that to you. August closed sales, you guys. So just like I said, I was not making this up. Look at this. We hit 69.88. Well, even, 68.58, even 67.22, right? Just about back to all-time highs. And this is August. So, for May, June, and July data, we do show that we surpassed these levels. So demand more or less back to all-time highs, but supply was not and is not, and probably isn't likely to be down the road either. So closed sales down 20%, back to just about 2014 levels. So that's another small but interesting observation, is that seller activity is back to 2012 levels, but buyer activity is back to 2014 levels. So take that as you will, take that for what it's worth. All right, market times. Let's talk about this for just 10 seconds, you guys. Homes taking 5 more days to sell. But that does amount to a 50% increase in market times, which means, where did we go from? Right, we went from 10 to 15. So we did have a notable increase, but market times are still near historic lows. So check this out. August median CDOM cumulative days on market. So you're on the market for 10 days, then you're off for 5 days, but then you're back on for 10 days. You're not going to fool me. I know you were actually on for 20 days. So here we are, 15 down to 10, back up to 15, right? So yeah, that 50% increase, 10 plus half of 10 is 10 plus 5 is 15. I can do that math. So, we're basically back to 2020 levels. So the COVID frenzy and the home buying craze really kind of shoved us down to 10. And in the absence of that, we kind of floated back to 15. Zillow said my house is worth 400,000. I'll give you 150. Look, home prices are continuing their ascent still, but at a decelerated pace. So, over the last couple of years, we have seen prices rise at 14, 15, 16% year over year. We're now seeing more like 6%, which is, again, much more in line with our historical average of 5 to 6%, about 5.5% before inflation, right? So 5% before inflation minus 3% to inflation. And that's our long-term average, right? Long-term average, 3% equals 2% real price appreciation. So not only is housing an inflation hedge, it also delivers real returns kind of above and beyond that. So, we're not really forecasting that prices will soften in the short to medium term, given this imbalance we still have. I do also want to call something out. There's 2 factors, 2 dynamics that affect price. One is obvious, supply and demand, duh, right? I'll take things that are obvious for 800, Alex, thank you. The daily double is the product mix effect, the PME, and this is something different. The product mix effect speaks to, I don't care if supply was up and demand was down, or demand was up and supply was down, prices can still fall. Even if demand was way up and supply was way down, prices can still fall if all that demand was on cheaper condos, right? What if all that demand was focused on more affordable product, smaller homes, existing homes, older homes, homes in the cities versus homes in the suburbs? So, I really want us to be thinking not just in terms of supply and demand effects, but also in terms of the mix of product. We've been seeing more $1 million+ homes sell. In fact, that market has doubled in 2 years, if memory serves, and I'm pretty sure memory serves. So, more $1 million+ homes selling, it's going to skew price higher. That doesn't necessarily relate to supply and demand as much as it relates to the mix of homes that happens to be selling is tending to skew toward higher price points. I hope that made sense. I kind of geeked out on that a little bit. All right, August median sales price in the metro. How come I'm using my mouse? How come I don't have my laser? Forgive me. Now I have my sharks with lasers attached to their heads. All right. So here you have it, folks. Prices up 10%, then 11%, and now just about 6%. So we're really seeing that deceleration. Price growth still positive, but at a lesser rate. We were going 75 on 35W. Now we're slowing down to 60 miles an hour, 60, 65 on the highway. We're still going at a relatively, decent clip, but it really does feel like a slowdown compared to where we were, just previously. Let's bring this one back, you guys. I know we've kind of set this aside for a little while, but year over year change in median price. So check this out. I won't wax romantic on some of the historical data, but Always interesting to see, in the bubble, and then the crash, and then the tax credit period, and then the real bottoming, and then the flippers and investors that descended on the market, and then maybe a little bit of a normal market, and then pretty hot COVID market, right? So, I mean, talk about data and charts telling a story. There you have it. There's your story. I mean, it's like a chronology. It's like a timeline, a history of what happened. So I don't know if you geek out on that as much as I do, but I just find that fascinating. I just do. Okay, so look at this COVID frenzy, right? So there's our 16%. I was not lying to you. Didn't quite didn't meet or match our 17.7%, but came close. And sure enough, guys, and maybe I'll zoom in just a hair on this. Sure enough, you can see that price growth rate coming down, right? From 16 to 6%. We stopped at 10 and 8 and 7. But here we are, 6%. So, it doesn't really worry me. I'm just not that concerned about it, because that's where we've been when we're not in this kind of phase 1 of recovery. We're not in a COVID market, or we're not in a housing crash, right? That's kind of where we should be. That's kind of where we belong. So let's keep tabs on it. Let's keep watching it and see where we kind of settle, see what level we settle into. Another interesting observation here, homeowners with fixed housing costs who aren't buying cars and who also aren't buying airfare just so happen to be experiencing much less inflation. So lots of different components to the CPI, but the shelter component is a big one. So existing homeowners with fixed housing costs, who aren't paying higher rates and higher prices, aren't experiencing that same sort of inflation. So that's a good thing. Speaking of inflation, hot topic lately, inflation adjusted home prices, median residential sales price in our metro. And this one uses constant $2,003. So let's break things down. In red, we've just got nominal home price, typical home price, the home price that we paid at the time. But in blue, this is where the magic happens. This is the implied home price in constant $2,003. So take a gander. In 2003, same level, because there was no inflation, because that was 2003. Right? But look at what we've paid in inflated dollars in red, right? These are inflated dollars. But look at what we would have paid had we stripped out inflation, had inflation not been a thing. Actually, we're kind of just barely above bubble levels, right, guys? Looks like bubble was just below 225, and now we're just above 225, maybe 235, 230 something. So, when we include inflation, it really makes it look like we've gotten ahead of our skis. I'll use that phrase again. I'm a skier. I like skiing. I'll use that phrase. When we really strip out inflation, we actually see that, maybe it's not as bad as this looks. And if only we could pay $2,003, but we have to use today's dollars. Another way to look at this, guys, you tell me what your preference is. Another way, instead of using $03, let's use today's dollars, 2022. So now, forgive me. So now, instead of saying these start at the same time, these basically finish in the same place. So here's what we would have paid in 2005 for a house if we paid using today's dollars. It would actually be $350, right? And our actual home price is what, $375. So here again, similar story. Once we take out inflation, once we strip that out, maybe we haven't gotten so far ahead of ourselves. So I find that interesting, just kind of looking at that difference. Speaking of inflation, you guys, I don't have a PhD in economics, but I do watch data pretty closely, and I do pay pretty close attention to markets. This is from the ISM Manufacturing Index, the Institute for Supply Management, or Institute for Supply Managers, I think. And this is data from Schwab and Bloomberg, and pretty recent data here, pretty fresh. So this is the percentage of supply chain managers that are reporting commodities are in short supply, going back to 1993. Pretty good data here, right? Commodities in short supply, 35% said commodities are in short supply, highest level since early 90s. How about those reporting commodities up in price? Over 50% were reporting that not that long ago. But look at how much it's come down. You guys have noticed gas prices at the pump have also come down. So frankly, I was a little bit surprised at the CPI reading, because you can kind of see and sense that the raw input costs in the background are starting to normalize and kind of come back down. Fuel, agricultural commodities, metals, stuff like that. All right, so payments. Let's talk payments, you guys. Definitely some challenges and some things to note here. So monthly mortgage payments have risen to their highest level since at least 2003, before inflation. And yet we're still really only spending just about a quarter of our pre-tax income on housing. So the average home buyer of the median priced home is still only really using a fourth of their income on shelter, right? And then don't forget, we're also, of course, better than our peer regions, as we saw. Okay, so you guys might be reading about this in the news or something similar, but it's probably not using our local, or I should say regional data. This, of course, uses our regional Twin Cities data. So what are we saying here? Until recently, historically low rates and rising incomes have partly offset price gains. What do I mean by that? Check this out. So let's just use 2020. Typical payment on the median priced home, $1,606. That's still below the $1,622 that we paid in 2006. How the heck can that be? Rates offsetting that. So prices, you guys, prices from 2006 are way up here. 2020 was all-time highs, 21 even higher, 22 will probably, very likely, almost guaranteed be even higher. So prices were way above, but payments were flat. And that's because of interest rates. It seems we are losing that interest rate advantage, or at least it is eroding a little bit. And so we've seen payments, payments definitely surge to all-time, well, yes, nominal all-time highs before adjusting for inflation. So I guess I can say that. Yeah, I guess we can say that. So here's a percentage basis. We spent 24.8% of pre-tax income on housing in 2006. I should say on the median priced home in 2006. And now we're spending 25%. So yes, that is higher. Yes, that is an all-time high. But it's just not that much higher, right? And it's still only about a quarter. So I don't mean to downplay at all. This is concerning. This kind of change, so quickly is concerning. And the impacts on affordability, surely are worrisome. But, maybe let's take it with a grain of salt and let's really think about it. Two tenths more. I don't know. I think people believe that it's worse than this. I think people think it's worse than it is in terms of percent. So check it out. Payments are well above this level. How come the percentage is barely above income growth? Here's the other part: low rates and rising incomes. That's the other part. So yes, even though the actual cost is well above 2006 levels, the percentage of income is barely above 2006 levels. And that's because incomes are higher here. So that payment represents, a similar sized chunk. Even though it's a larger payment, it's of a larger income. Okay, I think I've beat that dead horse enough. Let's move on, shall we? Let's stick here for one more chart. Sorry, guys. So this is monthly. So the last one was annual. You guys will notice 2006, 2007, 2008, 2021, and 22. This one's monthly. So we actually do calculate this monthly. So take a gander. I've labeled our data for June. So I've labeled every June. I suppose I could update that to August. I promise I'll do that next time. So June payment, and the most recent June payment. $2,500 a month, up from $1,800. Some of you may have heard this plus 50% number, that your typical mortgage payment is up 50% from a year ago. Our data shows it's 36% for us. New York, San Francisco, Atlanta, Burlington, Vermont, Charlotte, and Austin are all going to behave differently, right? Some could be above that 50 or below. But technically, we're only up a little over a third. I should not say only. Technically, we are up a little over a third. You cannot say only. That's substantial, no matter how you slice and dice it. So, believe it or not, sellers are still getting roughly 100% of their asking price, which, while down from last August, it is still historically high. So a little bit of a watershed moment here, you guys. We broke down under 100%. And that is the first August in a couple years where we've done that. You'll notice we are still above we're at the third highest August since 03. Right. So in 20 years, we've got the third strongest August in 20 years. So it's hard to call that weak, but it did weaken from a year ago. But is it really fair to compare to 102.5%? You know, it's probably better to compare to, 99 or 100%. Yeah. So the change looks extreme when you're comparing to such a skewed baseline. I guess that's the way I'll say it. All right, time check 42. I think we're doing okay. All right, inventory has risen slightly, but remains near historic lows. I'm just not seeing that we're at any risk of an oversupply issue occurring and dogging us anytime soon. So it's really the result of demand falling faster than supply, right? And we talked about how buyers are able to pull back, faster and easier than sellers. And then, of course, we're also comparing against, this sort of this unique baseline period. So there you have it. 37,000 active listings in the North Star system, down to 8,700. I'll climb way out on the skinny branches and say that is a significant change and represents a significant supply shock or just what is that, 80%, 75, 80% decrease in supply, while demand has only surged to all-time highs. This is what's pushing market times down. This is what's pushing home prices higher. This is what's helping sellers get really strong really strong offer prices. Oops, wasn't done there, guys. Sorry. So up 2.5%, yay, but whoop-de-doo, right? 2.5%, well, that's up from a pretty big decline. That decrease came because, we were still gobbling up listings. So listings that came on in August tended to flow off the market before the end of the month. So they weren't included in that inventory snapshot, if you will. And you'll also notice, even though up a little bit from 21, we're still down from 2020 and still well below where we've been in the past. Tom, 8,720. So we have about 20,000 agents across MAR and SPAR. And I think the state has, it was 22, maybe a year or two ago. So state's probably up to 23 now. Remember, demand is at all-time highs. So that is a lot of opportunity for agents. And also remember, well, until a few months ago, demand pretty much hit all-time highs. I got to keep reminding myself of that. And also recall that inventory is just a snapshot. It's just a snapshot of how many listings were still under active status at month end. So think about this: listings that come on August 10th and go off market on August 20th, guess what? You will not be counted as part of inventory. And arguably, because days on market hit a record low, never has that happened so much. So this is not capturing all the listings that are active in North Star during the month. Rather, this is just capturing how many listings are active in the North Star system at the end of the month. So, I mean, Tom, you definitely bring up a decent point, but let's broaden the lens a little bit and look and dig a little bit further. So believe it or not, we are still in a solid market. We're still in a solid seller's market where sellers have pricing power and the upper hand in negotiations. But yes, definitely slightly less so than last August. Of course, your area, price point, property type, and style of home may vary. So month supply. Here you have it. Used to have 10 months of supply 14 years ago, and we blew right past a balanced market, which would be about 4 to 6 months of supply. You guys can see we went right from 7.25 down to 4.5. We did not stop at 5.5. We did not pass go and collect $200. No, we did not. So now take a look. So yeah, absorption rates or month supply is up 18% to 1.8 months. Somewhat encouraging news for buyers, I suppose. But still below 2020 levels and still way below what would be considered, a balanced market where we're not favoring sellers, but we're also not favoring buyers. Neither side sort of has a clear market-wide advantage, if that makes sense. I really try to incorporate this one in just about every webinar we do because I just think it's important. I think this is one of the most powerful metrics to understand and to measure and monitor market change and market health and market shift. So I just always insist on including it, guys. I'll be brief though. Sellers markets, you got a lot of buyers, a lot of demand, all competing over the same listing. This seller is in control. This seller can name their price. They don't have to do any inspection wish list items. They don't have to do home warranties. They don't have to do, concessions, none of that. Buyers markets. So here the buyers have to outcompete and outbid one another to get the home. Here you've got a lot of supply competing over limited demand versus a lot of demand competing over limited supply. So here it is the sellers that have to basically outconcede one another. And throw, deal sweeteners in at buyers and maybe do some price reductions and so on and so forth. So that's a buyer's market. All we're looking for is a balanced market. It's where we wish we could be. It has proven elusive. All right, let's shift gears into luxury. Just for August, sales over 1 million. Gee willikers, guys, look at this 60% surge into August of 21. We did have to cough up, 10% of that, but gosh, we're still pretty elevated if you ask me. How about year to date? How are we looking year to date? So I think I referenced this earlier. So let's call this, be a little generous to me, call this 750 and call this 1500. 750 over 1-2 years into 1500 is a doubling in million plus activity in 2 years. Doubling. Right after we hit 500, it took what, 10 years to get back to break even? 10 years to even get back to break even. We just doubled in 2 years. We came down a little bit. Oops, I don't know why my percent change didn't carry through. Sorry, guys. How could I? My apologies. So yeah, up 25%, then up 50%. And now year to date, not quite as high as 2021 levels, but it looks like we are still going to end above 2020 levels. Cash deals as a percentage of all sales, excuse me, as a, well, I guess I noted it here, as a percentage of million plus sales, I guess I should say. But it's all sale types. So new, existing, I guess there probably aren't a lot of foreclosures and short sales over 1 million, but maybe. Condo, single family townhomes, new, existing, 10,000 square foot homes and 1,000 square foot homes. But as long as you're over 1 million. So let's take a peek. Come down a little bit. 23% of million plus buyers are using cash versus 10%, kind of interestingly, in 05 through 07. Some of this, I think, is changes in some changes to the tax law. I know there's a 2017 overhaul and maybe 1031 exchanges. I'd have to check with Eric, our government affairs director, but it looks like that could be impacting that a little bit. But, nonetheless, like Warren Buffett says, these things sometimes bob up and down, but let's look at the trend. The trend is our friend, and it does look like this is turning a corner a little bit. Maybe surprisingly, because these folks aren't as rate sensitive, are not as rate sensitive, but they're using cash. If you don't want to pay 6%, you got the cash, use the cash. Now, let me pause. When rates were 3% and the stock market was returning 25%, as it did for 2 or 3 years there, doesn't it make sense to borrow it at 3% and let your assets, let your capital earn and work for you at 20%? That makes a lot of sense to me, but the long-term average of the S&P is only about 8%. So if rates are 6% and the long-term return is 8%, there's not as much of a spread there. It's not quite as attractive. And then, of course, lately, markets are down across the globe because of inflation and high energy prices rocking nations across the globe, not just here. So, kind of interesting. How about cash deals for under 300K? So more affordable segment here. So fascinating. Just the opposite thing. These folks are rate sensitive. You also have some investors. I don't think there's the ROI. I don't think the ROI is as attractive to investors moving forward. Cost of capital is way up, and I think price growth will moderate moving forward. Already has, and I think that will continue. So interesting, guys, when you see million plus cash deals kind of falling, but you see more affordable cash deals on the rise. I guess I'd expect that to happen, but it's so fascinating to see. Oh my God, I love housing data. All right, and then overall whole market. So this is everything. This is 0 to infinity and beyond. Just about 14.5%. And you guys can see that's on the rise. Money was so cheap in 2020. Why would I borrow? Or sorry, why would I pay cash? Money was so cheap. Only 10% of us paid cash. I'd much rather borrow at 2.75% and let my money work for me at 20%. That sounds like a good deal to me. All right, hey buyers, what's up with you? What's going on? So consumers are kind of figuring out how to adapt, buying smaller houses, adding others onto the loan with them, buying down rates, or some are kind of waiting and seeing. Not sure that's going to pay off. And you guys can kind of see the breakdown here. Won't cover all of that. The Mortgage Bankers Association is showing an increase in ARMs. So some folks are betting that rates will be lower in 5, 7, or 10 years, depending on your adjustable period or balloon payments and that kind of thing. So some of these, I know we did talk about some of these last time, or a few of them, but every month we have new people on, and so I like to bring back some of the really powerful ones that are good ones, and this is one of them. So first-time buyers, right? 32 years old. When home prices went on sale in 07, 08, 09, we could be 30 years old to buy our homes. Then we had to wait 31, then 32, and now 33, as we've had to wait to save a little bit more for down payment. First-time home buyers, as a percentage of all home buyers, we're up 34%, right? Highest level since 2017, it looks like, as we had folks just scrambling to get into something. Median percent down payment, first-time buyers, about 7% down, so some 3.5%, some 10 or 20%. And then you've got your repeat buyers, more like 17%. So many more of those of the repeats are closer to 20% because they got proceeds from the prior sale to roll in, right, and to put down. So that's kind of what's moving the needle there. Seller tenure, 10-year kind of rolls off the tongue nicely. 10 years, guys. We've been saying, this industry's been saying for a century that generally people move every 5 to 7 years. 6 is more or less right in the middle of that kind of 5 to 7 range. Let me double check on that. I think that's a fact. And then it came down to 8 years, right? So lowest level in about 10, 11 years, as we again saw this COVID reshuffle, as people really were moving around more. Do you guys use Google Trends at all? I admit I really don't use it that much. I'm aware of it. I might check a few things maybe a couple times a year, but Google Trends is how you search interest in specific search terms. So I wanted to look at the popularity of the search term housing crash. And we do see it on the up and up. So more folks are searching for that. And I kind of find that interesting. I'm not saying that's going to materialize, but it does show. I don't know. I just think it's fascinating. This is all just fascinating. It does show, and allow. By the way, guys, feel free, just Google search for Google Trends, and I promise it'll be the first option. And whatever you want to do, find a realtor, buy a house, sell a house, and you can kind of hone in on states and geographies and times and stuff like that. So do play around with that. All right, from my friend Alex at Home Free TC, they are a transaction management company, right? I think that's what they are. Twin Cities inspections waived, 55% waived inspections in April. Right now, much more like a third. So from over half to more like a third. So kind of coming back to earth on that a little bit. Price reductions. A few of you really like these, and I'm glad we're able to do it and kind of keep everybody updated on it. So price reductions are up from last August. That's a fact, but price reductions remain near historic lows. Right, as we've seen with some other indicators, August also had the third lowest share of price reductions on record. And yet, right, so let's be generous, call this 14%, 14 plus 7 gets you to 21. That's a 50% increase in price reduction market share, or the share of price reduction. So that's a big increase, but it's not that high of a level, right? And guys, that's been a recurring theme. So, right, almost 50% of deals required a price reduction, in 08 to 2011, and now only about 1 in 5. So from 1 in 2 to 1 in 5, big difference there. Equity gains year over year, first quarter this year compared to first quarter last year. Typical homeowners up 30 grand in equity. Boom. There you go. Guys, this is underestimating. This is under. Our median price was 350, right? And 10% price growth on 350 is 35 grand, right? There you have it. 35 grand in homeowner equity gains. We're not quite like our friends in California or Seattle, but I'm also a little frustrated that we're behind the Hoosiers in Indiana. We're so much better than the Hoosiers in Indiana. I don't know why we're behind them, but anyway. Is this 2008 all over again, you guys? There's just no way. We have so much more of an equity cushion. Borrowers and buyers are so much more highly qualified. We're not treating our homes as ATMs. Unemployed folks are not buying houses, at least not anymore. They're not. There was a time where if you could fog a mirror, you can get a mortgage. People are getting current, coming off forbearance. And, think about this one. Even if prices were to come down 10%, the vast majority of homeowners still wouldn't be underwater because of that equity cushion. Homeowners have much lower rates this time around and higher incomes. We talked about that. We do not see mass layoffs yet, except for mortgage companies that are taking a second look at how many people they need in their refinance department, because there's probably fewer refinances happening now than there were. We've got a much better regulatory environment. We've got bank reserve requirements, and we just don't see the kind of predatory lending that we did. Oh boy, I better keep trucking here. I got a couple more. So mortgage originations, guys, 760 plus scores. Today's borrowers are so highly qualified. Look at the sub 620 higher risk borrowers that we issued mortgages to, and notice, those low scores just aren't really part of the market now. Hopefully, a lot of those folks have migrated up into the next bracket, right, into the next credit score or FICO score bracket. But something to think about there. You know what? We're going to skip those two. Yeah, new listing. So guys, take a peek at this. Nothing that worrisome, but I do want to show you because this is, we're really early in the process here. So let's keep tabs on it. New listings broken out by seller type. Forget traditional, that's just your regular sellers. And it's way, it's always way above these. So if we look at foreclosures and short sales flat. I guess you can kind of squint and turn your head to the side and make the argument that foreclosure listings are maybe starting to curl upwards just a hair. And then on the pending side, yeah, it doesn't look like we're seeing an increase in signed contracts, but first you got to get them listed, and then you'll see people having interest. Guys, even if we saw a surge in this, which will be nothing like 2008, I think you've got the investors there and some of the first-time buyers who are looking for those deals and those opportunities. I think they get absorbed, but I just don't see us having that kind of influx. All right, 4 of the last 6 recessions saw rising home prices. The one exception was, of course, the 2008 housing crisis. I'm sorry, one of the 2 exceptions. The major exception was the 08 housing crisis. During these 6 recessions, you guys, prices rose during 1, 2, 3, 4 of those 6 recessions, right? All right, so this is an interesting kind of a newer slide as we're thinking through some of this stuff. Will waiting pay off? Probably not. Rates are likely to rise further until we get inflation under control, right? Guys, the Fed is in control. The Fed is tapping the brakes. The Fed is destroying demand for loans, for capital. That's all the Fed can do is destroy demand for money. The Fed cannot drill and export oil. The Fed cannot grow food. All the Fed can do is really destroy the demand for money, and they're doing a pretty good job of that. So, it seems like there's this standoff that's continuing between buyers balking at higher prices and sellers clinging to their homes and interest rates. And then, those who wait will basically be swapping their affordability problem for a bidding war problem if and when rates fall. Inventory really isn't rising like some expected. And then think about this. If rates do fall, that 400K home could be back up to 420, 430, or 440. not including bidding wars. And then if rates fall, these next two are funny. If rates fall, great, then refinance into a lower rate. If rates rise, great, then you've already got a favorable rate. I didn't know that would rhyme, but there you go. Life is filled with surprises. And then those who buy now will benefit from a better price, or I guess maybe gentler appreciation and refinancing into a lower rate if rates do fall. So it may boil down to, a preference of paying more in interest or paying more in principal. In a lot of ways, it does kind of boil down to that. All right, I know we are running really low on time, you guys. Just a little bit of a rate projection, kind of heading into the third quarter. A lot of these folks, most of them smarter than I am. A lot of these folks are forecasting a little bit of an easing on the rate front, but they made these forecasts before the latest inflation data, which, while it was concerning, it was down, below its peak. Really interesting new one. When I zig, you zag. Look at the relationship between the change in the 30-year fixed rate mortgage and the change in our pending sales. Guys, I didn't realize it was this close. I knew they were related. I knew they were connected, but they're really, really quite close. So look, rates up, sales down, sales up, rates down. And look what we just saw, rates way up and sales really reacting, that same kind of equal opposite reaction, kind of in a Newtonian way. And with that, and just at 3:03, not bad. We did start a few minutes late. I will stop in the name of love, and thank you guys again for joining us. Just so thrilled you guys spent the time and stuck with us. So thank you, thank you, thank you. Last check of chat and Q&A. Let's see, looks like we have one. From my friend Christine, is there a way to measure when inventory is so low there isn't enough selection to satisfy the buyers who are looking? Yeah, I mean, I think, Christine, you're really just talking about month supply. You're talking about that ratio or that relationship between supply and demand, and month supply of inventory is one of the best ways to measure that. It's one of the best measuring sticks that we have for that. Whether there's a magical number, I guess that's a little harder to say, when inventory is so low. I would say when we hit 1 month of supply, and we hit it, I think we actually fell below. I think we were 0.8, 0.9 for a month or two there. Under a month is just too low to have a healthy market. Even under 2 months is just too tight. So, I mean, I would say under a month and a half, especially, under a month, but mostly under 2 or 3 months, inventory really is not adequate to satisfy those buyers. But again, when we get under a month and a half, especially under, month and a quarter, it's really hard to have success, especially for those under the median. Let's see, one follow-up. I've seen the ratio of single family and condos be as close as I've ever seen. Oh, that's an interesting observation. I was looking at that the other day. We may have to hold on that till next time, just to be respectful of people's time, as much as I'd love to geek out on that now. Well, should we geek out on that? Nah, we shouldn't.
I think we're over time, David.
We shouldn't. I'm tempted,
thank you all so
shouldn't.
much. I did put the link to next webinar on October 20th in the chat. Please click on that link. We can probably dive into those interesting questions and others in our next webinar. But until then, thank you all, and we'll see you in October.
Thanks, guys. See you next time.